Hey everyone, this is Robert Keens with goldsilverpros.com. It's Tuesday, September 15th, 2020. For today's video, I wanted to talk about, expand upon what I've been talking about recently with the shadow contracts on COMEX and talk about the implications of what that means, as well as dropping an additional bombshell about the eligible inventories on gold on the COMEX. Let's go ahead and get started. Before we get into the new content, I wanted to go over an article that I wrote on FX Empire. It was published on September 7th, 2020, and it's called COMEX's Gold and Silver Futures Market Trade Data Not Adding Up. This article received a lot of praise because it spread basically all over the internet, but also I received some criticism and or some confusion about what I was saying. I wanted to be clear here. I wasn't saying that the numbers on the CME Group were actually fraudulent, but that they obfuscated the trades and what was going on in the market. And I'm going to basically prove that in today's video, and this will clear up, I think, some of the misconceptions over what I'd written in the article. And we'll get to what I wrote in the article, but essentially the argument was that there were 3,070 contracts that rolled over from August to September for the September delivery month of open interest, and yet there has been many more contracts delivered. As we see here, there's been in gold 4,191. So if this were a true futures market, you wouldn't have more deliveries than you had open interest open at the beginning of the month, since the beginning of the month from June, meaning a futures position. So what's happening is there are many more deliveries being made than there were open interest, meaning people are coming into the COMEX the same delivery month, opening and closing a contract and taking delivery that same month. That's not a futures, that's a now. Now is the same time. And further, the analysis of the data on the CME shows that this is happening almost on a daily basis. So people are coming in, opening a contract and closing it almost the very next day. That by definition is not a futures contract. Now, I wanted to explain why this should be an issue, even though it may not be against exchange rules. And I want to emphasize, I never said this was against exchange rules, but this shouldn't be the way the market trades. When I took my Series 3 commodities license, I had to do this when I was working for a currency broker firm many, many years ago in the finance area. So I passed a Series 3 license. Currencies were covered under commodities, the Series 3 material in the Series 3 exam. This is a government issued exam, basically, with the financial regulatory authorities. And in that literature for the Series 3 exam and on the test, it asks you to understand why the futures exchange exists. And the whole reason the futures exchange exists is for producers and merchants, for legitimate hedges. Let's say you're a wheat farmer and you're planting wheat and you hope to get $10 a bushel, and that's your per bushel of wheat, and that's your estimate for when you're planting. That's how much you plant and what you spend on fertilizer and how much time you spend and all that good stuff. Your machinery that you buy, the loans that you have to pay off, and your transportation costs and all that. So you're hoping to get $10 a bushel, but you're afraid that because wheat may be coming from China or somewhere else, say, some South American nations producing wheat, and you think it's going to come up and there's going to be a bumper crop and it may have excess supply, that the price could actually fall to $5 a bushel. So what you do is you go to the futures markets and say, hey, I want to take a bet, a legitimate hedge bet. You take a short position, and let's say it does fall to like $6. You would have a $4 loss on the price of wheat that you sell at the actual time that you sell your physical wheat, but that's offset by the short that you took in the futures market. You got most of that money back in the futures position because the price had fallen. So you're in the money on a short bet minus exchange fees. So you took a little bit of loss in exchange fees, but you didn't take that massive loss that you would have of $4 a bushel when you went to sell at the market, when it sold for $6 instead of what you hoped to be for 10. That's a legitimate hedge. Same thing for producers on the other side. Merchants on the other side. They want to obtain their materials to make their products as cheaply as possible. And if they think the price is going to rise, they may take a long in the futures market. Let's say the price of gold rises from $100 to $150, and somebody's using gold in their jewelry as a merchant jeweler, then they may take a long position and protect them against that $50 rise. That way they would close out their long position, take profits, and it would offset the loss that they'd have when they bought gold for more than they expected. That's legitimate hedging. We know that this market's not a legitimate hedging market because if you look at the amount of position, it dwarfs the overall amount of production. Let's just look at the position, 557,000 open contracts of gold, 100-ounce gold. That dwarfs the actual amount of gold produced in that time. Same thing with silver. In fact, it's even worse than silver. 158,000 of 5,000 ounce gold, 158,000 contracts of 5,000 ounce gold. That's more gold that's produced at that time between the time you take that position and that contract closes, usually anywhere from a month to 3 months. So these positions are mostly not legitimate hedges. They're speculative. When you have these massive open positions, especially short, it hammers down the price. It's called hammering. I'll show you some research later which talks about that. So let's look at gold for a second. The swap dealers are the bullion banks. They have 259,000 contracts of 100 ounce gold in a short position. That outweighs the actual amount of physical gold that's called a naked short that has the effect of lowering the price of gold. And I'll get back to why that is the case later, but that is the truth. Now, how does all of this tie to the numbers on COMEX? Let's start to talk about the numbers in COMEX and then relate it to the inventory bombshell that we have about the eligible gold on the COMEX. So you can see here in gold, this is for Monday, September 14, 2020, gold volume. On the CME Group website, we have 175 deliveries. The open interest changed only 153. So if you had 175 deliveries, an open interest should have changed by 175, unless new contracts were open on top of that. So say 22 new contracts were open, you could balance this number. How many new contracts are there? I don't know. It doesn't say anywhere. This is one of my problems with COMEX. You can't balance the numbers. I'm a former auditor. I did a lot of technical audit and some financial statement audit, and I was taught how to do this by two of the big four companies that I work for. And you want to look at a balance sheet, an income statement, a cash flow statement, as well as other supporting documents so that you can balance all the numbers and you can have an opinion on, you opine or you issue an opinion as to whether the financial statements are true in all respects based upon the data that you audited. And in the public company sector, that's regulated by Sarbanes-Oxley legislation, which came out in 2002, was first enforced in 2004. The very first audits I did were in support of Sarbanes-Oxley. The whole reason to have the independent audits is to validate the data in the financial statements, but at least they have financial statements that actually match. Nothing on the COMEX actually matches. The reason is because they don't break out enough columns. They don't break down deliveries made for same month contracts versus contracts that were taken months before. In other words, a spot contract versus an actual futures contract, which is what the futures market is supposed to be. They also don't break down the total volume. The settlements volume number here is not the actual volume. So the estimated volume for settlements for September is 74. Settlements in the glossary at CME Group, which I showed you in the very last video I did on the subject, I think it was last week, may have been last Tuesday at this time, or yeah, I believe it was last Tuesday at this time. The settlements is all of the paper market cash settlements and the physical deliveries added together. That's a settlement. Well, if this says 74 here, settlement estimated volume. And why is it estimated? Shouldn't you know? Why the hell would it be estimated? But there are 175 deliveries alone, and it appears as though there were at least 22 new contracts open. And we don't know how many were actually settled. The open interest could be 22 new contracts open, or it could be 100 new contracts open, and 78 other paper contracts closed. That's the thing. You can't tell how many of these are closed and opened. But anyway, that plus 175, whatever that is, would be higher than the settlement number. So the settlement number, this estimated volume under the settlement tab is not actually settlements. This is where it gets confusing. Not only that, you can't add the numbers, you can't match the numbers. Now you've got this number over here for September 14, a total of 211,000 open interest, or volume, 211,000. Where is that reflected in any of the data? How does that add up with the 175, the 153, and the 75 over on the side? I don't even know how these numbers add. It's not a balance sheet, not a cash flow statement, not an income statement. And by the way, I've never seen an audit of the CME Group published that proves that these numbers are true and correct. You know, in auditing, we have a saying, it's trust but verify. In this case, looking at what I look at and the inability to actually balance the numbers, it's verify and then trust. That's the issue I have. Now, none of these numbers have to be misstated. It's the way they report them. These could all be legitimate numbers. We don't know because there's no audit that's posted on their website that tells us. And we sure as hell can't audit the numbers ourselves. They don't add. We don't have enough detail. We don't have enough breakouts of separate accounts and separate trades and separate volume in order to do that. How do we know that the numbers are accurate? We don't. But it doesn't matter because what it's doing is obfuscating what's going on a daily, weekly, monthly, annual basis on the COMEX. What's really happening, what we call shadow contracts, or what we don't expect to happen. When somebody comes in the same delivery month and takes physical delivery on a same month contract where it's not a futures contract, it's supposed to be a futures exchange. That's the whole point. Future pricing hedge risk, or hedging your price risk. Future, not for immediate spot delivery. Now, how do we know this immediate spot delivery? Look at the gold volume. Going back to this article I wrote on FX Empire on September 7th, 2020 has been making its rounds in the gold and silver community. A lot of people have praised it. A lot of people have said, we're not so sure about it. Some have actually openly criticized me about this article. I've talked about that in a previous video. I wrote in this article, COMEX gold and silver futures market trade data not adding up. And I did about half of the equation here. And I think that's what's confusing people. And it was just to make a point about the shadow contracts, not to get into the whole lengthy problem that I'm going to get into today. But I'm going to do that today to clarify things. But if we go back to the last rollover day, which is August 28th, this is an August 28th report daily view on CME Group that I screenshotted. Those contracts that had been taken before September 4th, the September delivery month, there were 3,070 rolling over. So that means we should not have had more than 3,070 deliveries if these were actually futures contract positions. But we look at the month-to-date delivery notices for gold, and we're already up at 41.91. Last time I checked, basic math, 41.91 is higher than 30.70. So at least, what, 1,121, am I doing my numbers right? 1,121 contracts were posted for delivery in September, like immediate delivery, like open, close, give me the metal. It's not a futures position, guys. That's a shadow contract, or it's a spot contract, whatever you want to call it. It's not the reason why we use the exchange. And that's what I go into detail in the article. But there's more significance to it than that. And that's what the rest of this video is going to be about. I'm going to talk to you about that. Now we need to talk about inventories. I'm about to get to the bombshell, but I want to show how the CME Group has been misrepresenting their inventories and how they admitted on their website for a very, very long time and why that is significant. It's interesting that on April 1st, April Fool's Day of this year, there were two articles that came out, one on the LBMA website and one on Bloomberg, that were attesting to the fact that the COMEX had plenty of gold. So here, why is the LBMA, first of all, why is the LBMA talking about the COMEX's gold? Why the hell doesn't the COMEX come out on April 1st and prove that they have adequate gold? Why is the LBMA attesting to it? Who in London is panicked about the COMEX gold market? That tells you right there, somebody in London's panicked because it came out on the LBMA. What the hell do they have to do with COMEX? I don't know. CME Group's New York depositories are operating normally, I'm reading here, as have been deemed essential businesses and deliveries are occurring as planned. As of March 30, 2020, our depositories currently hold 9.2 million ounces of gold with 5.6 million ounces eligible. Remember, eligible means not on the exchange for delivery. It could be owned by anybody for any purpose, and there's no guarantee that gold can be put back up for delivery. I've already proven that in previous videos, but it says they have 9.2 with 5.6 of those being eligible, meaning we have no idea whether that 5.6 of that 9.2 would ever see the light of day on the exchange again. Nearing a record high in terms of stock levels. Stock information is updated daily, blah, 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 blah. On the same day, Bloomberg comes out with an article. Hey guys, there's ample gold to go around the futures markets after all. And then they show this chart about the metal inventories. And they're not making the distinction between eligible and registered. Not making the distinction between eligible and registered. Now, the inventories have gone up, but we'll show where that doesn't really matter based upon a CME Group admission. We'll talk about that in just a moment. I wanted to give full credit who found this bombshell on COMEX. It's Ronan Manley on Bullion Star. I'll put the link down in the description. If I forget to do it, it's highlighted right here on your screen, or you can just go to Bullion Star and look up all of his articles. It's on his blog. He talks about most eligible vaulted gold has nothing to do with COMEX. I've stated this before, and he's confirmed that. He wrote this on April 16th. Now look at how all this is lining up. The LBMA comes out on April 1st, says we have plenty of gold. Bloomberg comes out on April 1st and says we have plenty of gold. On April 16th, Ronan Manley says, wait a minute. And he basically, I'm not going to go over his whole article, but he references a document released by the CME Group on their own website. So it's not Ronan Manley supposing that eligible gold has nothing to do with COMEX. It's the admission of the exchange. It has nothing to do with COMEX. So this is on the CME Group website. You can see the URL right here. I'm on their website right now. And it's about regulation, notification, spot month position limits, blah, 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 blah. So they're saying spot month position limits. So they're kind of obfuscating what this document's actually about. Spot month position limits are basically in that spot month, what is your position limit as a contract trader? I mean, in other words, how many futures contracts can you take? And they start off with that, and then they bury the inventory revelation in this document. Notice how the CME Group didn't go out to Bloomberg and say, yeah, and go out to LBMA and say, maybe this is incorrect. Let's issue a very public press release dealing with that specific issue. They took this inventory data and buried it in a document that's talking about something else. It's talking about position limits. That's just position limits somebody can trade in a given month. That has nothing to do with inventory of gold or silver on the exchange. So here's the bombshell in this paragraph, buried on like the second page. Let's read it, shall we? The exchange determined at this time to base its estimates of deliverable supply in gold on eligible and registered stock stored at exchange approved depositories. So, and there's their admission. They had always been basing their liquidity in the market on eligible, even though we know that they don't know that that title will ever be transferred for a warrant for a futures delivery. It could be long-term storage, and they admit that right here. The exchange recognizes that gold is used as an investment vehicle, and as such, some gold stock may be held as a long-term investment. In other words, it's never coming back to the exchange. Some, as in how do we determine that? Let's see. While surveys conducted indicated no clear consensus as to how much gold is dedicated to long-term investments, in other words, they have no damn clue, the exchange, in an effort to represent a conservative deliverable supply that may be readily available, blah, 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 for delivery, made a determination at this time to discount from its estimated deliverable supply 50%. So in other words, all the eligible gold that they say is on the COMEX, I just happen to have a chart from Nick Laird's site, Gold Charts RS. It's this chart right here. These eligible stocks is light green. You take a 50% haircut, it's right off the top. What have I been telling you, ladies and gentlemen, about eligible gold stocks and how it represents gold that may never come back to the exchange, and how all of this represents all the gold taken off the exchange that people are going to hold for when there's no more gold left? Isn't this the CME Group admitting that? The exchange, oh, and this is the bigger bombshell. And there's two more bombshells I'm going to give you. This just gets so delicious. The exchange may, at a later date, determine not to discount such stock or to recognize a discount level that is more or less than 50%. So in other words, there's no consensus based upon their questionnaires. So they ask the depositories how much of this is eligible, and the depositories said, we don't know. And they said, well, randomly, haphazardly going to put 50%. It could be more, could be less in the future. We don't know. We have no damn clue, and we'll change it whenever we want to. So do you feel comfortable going to this exchange that they have all this gold they say they have? I don't. Well, and so there's a table saying, okay, so we're going to revise all our estimates dating back, and here's a 3-year average. So they're basically having it here, saying, oops, let's go back and, say that we lied for the last how many ever years. So here's where it gets really, really interesting. This is where I think they're getting desperate. This paragraph right here, again, buried in a document that's talking about position limits. Actually, the bigger bombshell has to do with inventories. Position limits are just the amount of trades a given person can make, paper or otherwise. It has nothing to do directly with inventories. But they're talking about inventory data in this document. They're hiding it, in other words. They're saying, oh, we published it. But if you were doing a random search on their website, you would not have found this, or on the internet. You have to have people like Ronan Manley watch these documents to see this, to see these admissions. They're obfuscating the admission about the inventories itself, much less obfuscating the damn data. This is what they do, ladies and gentlemen. They obfuscate. They don't tell you the full truth. They don't directly lie, but they don't tell you the full truth. If you don't tell the full truth, it's basically the same thing as admission. It's basically lying to me. And it's basically fraudulent. People say they're not doing anything fraudulent. Yes, they are. They're misrepresenting what they have. That's fraudulent. They don't have to lie directly to have it to be fraudulent. They just have to mislead you. It's the same damn thing. And I don't care from a legal perspective if that's fraud. To me, it's fraud because it affects how people make decisions on this exchange every day. All right, now, the second bombshell. The exchange does not currently account for exchange-grade gold stock stored at unapproved depositories that can be moved economically into exchange-approved facilities. The exchange made a later date determined to account for such stock. Oh, this is gets really good. So these depositories, whom we've never had any control over, any oversight over, we just may grab their gold and move it into our depositories and say it's all good. We don't know where it came from. We don't have these rules about how it got in there, but don't worry about all that. We need gold. We're going to do whatever we can to get it. We're going to go to a previously unapproved, unregulated, anything depository, grab their gold and just say it's all good. Don't worry about that chain of custody stuff. What chain of custody stuff? Oh my goodness. Let's talk about chain of custody. So I've shown you this document before. It's a precious metals physical delivery process outlined by the CME Group. They have their delivery cycle and all this stuff I've been talking to you about delivery day and this chart I showed you a month or so ago about first intent day and all that good stuff. They also have something in there about chain of title. Chain of integrity, approved refiner facility, approved assayer, approved depository, into the exchange approved depository. They have all these controls around approved, but they're telling you here, we may consider unapproved. Can they prove chain of custody, chain of integrity? Gee, I don't know. Not previously unregulated. Are you going to slap some regulations on it, call it good at the last minute? Well, let's talk about their inventories. Let's talk about, you know, are these audited? People, there are some people in response to my article over here who have said you're wrong, they audit. Okay, fine. Do they audit? Well, they never published an audit that I know of. And the individual depositories, when talking about physical stocks, do their own independent audits. I don't know if the CME Group, in fact, I do know the CME Group does not validate that because they admit it in the same document. So the CME Group has this market regulation department at CME Group. And this is what they do. By the way, this is to make sure that the individual, these exchanges fulfill their self-regulatory responsibilities. So CME Group is allowing them to self-regulate and allowing the depositories to self-regulate their physical inventories. Here's what they do. They approve and inspect facilities for physically settled metal. Now, notice how they didn't say they actually audit the metal or validate the metal or do anything with the metal. They just approve the facility, the building, okay? Not what's in it. Key, that's key to know. They ensure the facilities meet exchange rules. Well, that's great. Remain financially stable. Wonderful. Publish inventory reports coming from the depositories themselves, not audited by the CME, by the way, for metals, products, and exchange-proof facilities. They issue notices, blah, blah, blah. The CME Group is not, you know, their market regulation department is allowing them to self-regulate the exchanges and the depositories. And they don't print any of these audits. Now, there are independent audits of the depositories. They're not printed. Here is for GLD, done by SPDR Gold Trust. Here is by Bureau Veritas, an audit of their gold bullion. They publish it online. You can see it right here, spdrgoldshares.com, blah, 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 blah. Date, March 11, 2019. There's a published audit report of inventory. Why don't they publish it? This is the exchange. We're not talking about GLD, which is a fund. We're talking about the exchange for which all prices of gold and silver are determined across the world. Where's the audit? How do we know that their inventories are legitimate? And again, they've admitted, we're going to take a haircut in this paragraph of 50%, and that could be totally random, and we can move it up and down, and there's no consensus. Remember, no consensus. While surveys conducted indicated no clear consensus of how much is dedicated to long-term investments, meaning you're never going to see it on the exchange again. And no audits, at least no published audits. And it's self-regulatory from the exchanges and the depository perspective. Are you starting to feel all warm and fuzzy about these inventory numbers? You just feel like, oh, we just know that they have it. Yeah, right. Give me a break. This is a mess. So in response, about the same time, the COMEX started these other schemes around inventory. And I want to talk to you about it. We're going to go to the Schwarters article first. Now, I've shown this one before in one of my videos. The CME pushed to change gold delivery rules amid coronavirus lockdown. They're blaming this on coronavirus. Like there's any deliveries. They're saying the coronavirus has prevented gold going from London to the US. And so what we got to do is create this scheme to back the COMEX gold with London gold because we just can't deliver it. But we're going to guarantee it using an ACE program. And we'll take a 400 ounce bar over here and we'll say, well, you trade 100 ounce on COMEX. So we'll do this ACE thing. If you do one 100 ounce contract, you have a paper claim that's 400 gold ounce bar, but you got to do all four to get all, the whole gold bar because we're not going to split the gold bar. We're not going to cut it because coronavirus stopped all these deliveries. Well, as Bullion Star points out, Rhoda Manley, this chart from Gold Charts R Us, in 2019, the U.S. didn't import any gold from London. They imported from Mexico, Canada, Switzerland, Colombia, Nicaragua, Peru, Russia, and all these other. You don't see London on here anywhere on the chart. So how could coronavirus lead to lack of deliveries from London and the lack of liquidity in the COMEX exchange when in previous years, there wasn't any delivery from London to the COMEX. Look at the chart. No delivery. So what the hell does that have to do with the price of tea in China? It has nothing to do with inventory shortages. Maybe what has to do with the inventory shortages is people doing same month contracts and robbing the damn gold and silver off the COMEX exchange, in violation of why the COMEX exchange exists in the first place, for future market price hedging, not same month delivery, not spot contract delivery, not shadow contracts, whatever you want to call it. I don't care. Call it whatever you want. I don't care. Well, here's this handy dandy chart from Gold Charts R Us, Nick Laird's site, of which I'm a subscriber, showing you about the same time they're thinking up all these schemes. Look at the gold deliveries. People are taking gold off of the CME. Look at this. It doubled from October, what is that, October 2019 to, late 2018 to about now. It doubled. Maybe that's why they're trying to rig up all these schemes here. There's another scheme, by the way. I want to show you this one. Not only are they trying to guarantee COMEX delivery with gold. By the way, there's only been 32 of those contracts redeemed so far, because I don't think London has all the gold. I've talked about that in a previous video. But they say, well, and not only are we going to use these unapproved depositories, which I showed you earlier in the video a couple of minutes ago, that we've never regulated before, as long as they claim to have some gold, we're going to use that. We're going to go out and try to scrape gold from these unapproved assayers. So previously I'm on the gold tab right here, there were 71 minus 3, 68. Now there are some about 115, 120. They've doubled the amount of people that can make the delivery bars on COMEX, 100 ounce in the kilo. With silver, they had 78 minus 3 is 75. Now they have around 140. So they doubled the amount of people that could give delivery bars to the COMEX. Why? Because they're running short of inventory. That's the only explanation. I keep pressing the issue. The inventories are short. I don't give a damn what their inventories numbers say. Let's look at their inventory numbers. Let me go to this spreadsheet. This is the silver stocks. And this is all the way back in August. And I pulled this report for another reason, but I'm going to show you what they report in August. Total eligible, 208 million. Well, if they have 208 million, why are they running all these inventory schemes? And if they had 208 million, why, when Brinks had to settle futures contracts, did they have to import 597,000 ounces of silver on a single day in August that didn't come from eligible? If eligible was to reliably be used for futures exchange, why is Brinks continually, and I've showed this in previous videos multiple times on these daily reports, where Brinks is bringing silver and gold off of the COMEX, not from eligible, to settle trades? Because it's not there, ladies and gentlemen. That's why. Guess what? About that same time, August 10th, the same thing in gold, 160,000 ounces. Didn't bring it up from eligible. No change in that number. See, no change. Take this number minus this number, no daily change. That's what I do every time I pull these reports. I take this number minus this number and show me the change. And then I highlight the ones that stick out. They brought it from off market. It didn't come from eligible. Why? They don't have the inventory. All these signs, they don't have the inventory. All this goofy stuff, they don't have the inventory. Why? Because people have been taking it off. And the COMEX can admit there's a 50% haircut. So now you know the significance of why them not reporting the data and not letting us see how many same month or same day contract deliveries are coming in to the markets is basically, it would have caught them lying. If we had been able to balance this like a balance sheet, an income statement, a cash flow statement, like you do in corporate America, when you audit your financial statements, and you have the independent auditors through SOX, and you have your internal auditors, and you have people coming in and checking this twice. Actually, it's checked when the accounting is done. It's checked by the internal auditors, and it's checked by the external auditors. So there can still be errors, but at least it's checked 3 times. So it's reasonably assumed to be accurate. No published audit reports. The numbers are obfuscating the actual trade, which allows all this other goofiness to happen, all this inventory to be taken off. That's why these shadow contracts are pointing out the issues with COMEX. And COMEX lying, and everybody else lying to us, the press, the LBMA, and the press lying to us about how healthy their stocks are. They're lying because they're taking whatever the COMEX says. And then when the COMEX admits that they're eligible inventories, they have no clue how much of that could be used against a futures contract They bury it in a document that has nothing to do with that, and they call it position limits. And they have all this crap about position limits, and then they bury the actual inventory numbers down here, and the fact that they may use unapproved exchanges down here. How would you ever know that? It's not talked about in the press. Why is the CME Group enabling this scheme to go on? Why are they enabling people to take the gold and silver off the exchange? And I want to show you how this works, by the way. We're going to go back to the COTS report. This is a commitment of traders report through September 8th. This is the latest one, and I want to talk about gold here for a moment. Swap dealers are the bullion banks, and notice how they take both long and short positions. Why on earth would you take both long and short positions? If you want to short the market, just short the market. Because what happens is when you take a massive short position, these are naked shorts. They're not backed by actual metal. Remember, there's not enough metal there. Even if you look at the published numbers, there's not enough metal to satisfy that contract, all those short contracts, especially when you add up everybody else's shorts. There's a massive total amount of short positions. And it dwarfs what's actually available for the exchange. That's called a naked short. It's not backed up by anything. That tends to drive the price down. Well, the swap dealers will present all these naked shorts to drop the price down along with these other shorters. And then they'll present their longs for delivery, 79, 71. That's how they get the gold off the market at a cheap price. You play both sides. When you can play both sides of the market and push the market around, manipulate the market, ain't it great? But you couldn't tell that in the numbers because that's not the way it's presented, ladies and gentlemen. They don't give you transaction. How many times have I harped on transactional data? Break it down for me. Break out multiple columns that say same month deliveries, previous month deliveries, and tie it to an account and who is actually doing it. Which producer, which merchant, which swap dealer, which managed money, which other reportables. And then print the volume numbers that actually tie out the changes in open interest and the deliveries, the changes in paper and the physical deliveries to the actual volume on a daily basis. And then give me more than 1 month of inventory data. Every time I pull these physical inventory reports, I got to pull them by the day. There's no way to do a time analysis, no way to do any sort of projection. How do people trade this market with this damn data? It's horrible. It's god awful. And again, they don't have to line these individual numbers. It's obfuscation. They don't add up. I'm an auditor. I'm telling you, they don't add up. And it obfuscates the fact that they don't have a lot of inventory left. And these, when you see these deliveries outweigh the open interest, people are rating the market because we think we're at the end. Why? Because all these inventories. Because COMEX admits they don't have that many inventories and they bury it in a document, even when the general press, here and here is lying about it. But we can clearly see in the chart, that's what they've been doing since the tech crisis. There was no registered stock before the tech crisis. It didn't exist, okay? Before the tech crisis, there was no such thing as eligible gold. And then a couple of years after the tech crisis, they changed it to eligible gold and everybody pulled it off and all the gold's sitting in here and then it's not going back to the exchange. And they only have about a 50% confidence interval, any of it will, but they can't, there's no consensus that any of it will ever come back to the exchange. You know, if we reach $10,000 gold, could some of this come out eligible back to the exchange for sure? But by then, the futures market will probably be broken. And I'm not sure a lot of people are going to let it go at $10,000. If we have a major bond default or a currency crisis, people aren't going to sell their gold for anything. It's crisis insurance. What's to say any of this goes back to the market? My goodness. That's why this is an issue. It's obvious. Hello. All right, now there's one more thing I want to point out, another bombshell. So, are the markets manipulated? Is there any evidence whatsoever, Rob, in the past that maybe there was manipulation? Gee, I don't know. Maybe a 500-page paper written by Jerry Markham. It's available on Yale Law, Digital Commons website, Yale University. I don't know. 500 pages? No, I don't know. Yale Law. That's not decent proof, is it? Manipulation of commodity future prices, the unprosecutable crime. This paper in a nutshell basically goes on to say that the entire reason we have any regulation in the futures market is to deal with the previous manipulation, meaning every regulation ever printed has to do with previous manipulation. The manipulation has been going on ever since the futures market exists in America over 130 years, dating back to the mid-1800s. Thank you very much. And further, the CFTC has not been successful in its efforts to prevent and punish manipulation. It was created to deal with the issue of manipulation. Ding, 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 ding. There was amendments when it didn't work, and then it proved to be ineffective, and then they went back again, and it's still proven to be ineffective. I don't know. Is there a history of manipulation? Whoa. I think there's plenty of proof. The paper goes on to say that a better methodology is needed. In other words, what's in place cannot stop manipulation. Yale Journal of Regulation. Is that a reputable Is that a reputable research? Is this a reputable place to get the data? Well, let's go read some of the content. I can't read the whole paper. It's 500 pages, but I want to go to page 331 because it's just awesome. All right. The CFTC has created an order to deal with manipulation. We're going to read a few paragraphs. Don't fall asleep on me, guys. This is really interesting. Stick with me. We're almost done with this video. Stick it another couple of minutes. The problems in the commodities markets, as well as a series of articles in the Des Moines Register, which attacked the CEA, we'll see what that is in a moment, the CEA, as being ineffective regulator, led to a series of congressional hearings and new legislation was proposed. They had congressional hearings due to ineffective regulation. Hello. Then they had a Senate report that noted there had been a major shift in a market-oriented economy. Here's the key. As a result, futures are playing an increasingly important role in pricing and marketing a nation's commodities. Pricing commodities. In other words, it's not just you going to a grocery store buying it that determines the price. It's the futures market on all commodities that determines it first before it gets to the supermarket, okay? Or it gets to your gold dealer if you wish. The consumer also becoming increasingly aware that futures markets were, this is the last sentence here, having a direct effect such as matter of grocery bills and the cost of the home. In other words, futures markets determine price. Gee, didn't we already know that? It's not legitimate physical trade. It's the damn future speculation. The reports say that properly operating futures market helped to hold down consumer prices. On the other hand, improperly operating futures markets could have an opposite result. They could distort the market. I'm going to go down to this paragraph. We're going to skip around. Congress determined that the problems in the commodity futures industry brought about a crisis of public confidence in the 1970s, 50 years ago. Gee, I don't know if these ever been manipulated. It's 50 years of research. Congress found that self-regulated by the exchanges had not been effective in stopping abusive trading. Where have we seen self-regulation? Self-regulatory responsibilities of these markets. The CME's 4 markets are self-regulated. Congress found that self-regulation by exchanges had not been effective in stopping abusive trading. That's 50 years ago. But the CME Group wants to self-regulate. Should we trust them? Yeah, I don't know. Do you guys trust all this? When they're self-regulating, when the history has shown that Congress found that self-regulation doesn't work. Hello, do you see the problem? Further, many futures contracts were completely unregulated because the Commodity Exchange Act, that's the CEA we mentioned before, had not kept pace with the developments in the industry. These contracts included the first 2 that they list. Gosh, this PDF is hard to highlight. Silver and gold. I don't know. Does self-regulation work in silver and gold? No. Were there problems in silver and gold manipulation? Gee, I don't know. What does the paper say? Oh, this is just too much. I'm too good sometimes when I do this research. I'm sorry. I don't like to brag on myself, but this is too good. To remedy this concern, Congress passed the Commodities Future Trading Commission, CFTC, Act of 1974. That's what we have now, in which the paper went on to find at the end that basically it's broken and doesn't work. I'll let you read that section for yourself. It substantially amended the Commodity Exchange Act by creating a new federal regulatory commission to regulate the CEA. This agency, because the CEA basically failed. So it's not the first agency that's failed. This is the second one, and this one failed too also. The CFT was given expanded powers in the Commodity Exchange Act, including adjunctive authority, and was given exclusive jurisdiction over all futures trading. A significant provision was that enacted as a means of preventing violations to declare a market emergency, blah, 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 blah. You can read the paper. But they're saying that the CFTC has not been successful in its efforts to prevent market manipulation and a better methodology is used. And that self-regulation doesn't work. But that's exactly what the CME is doing, self-regulation. And by the way, they're not even printing their audits. So I don't know. Do you believe these reports? Not sure that I do. Can't prove it. One poster we were having this discussion on Twitter, and he actually said this, and he's in the gold and silver market. He runs a company in gold, and I think he actually may be regulated. So maybe this is why he said this. I don't know. They said, Rob, you can't prove anything with those numbers. You can't prove they're doing anything wrong because the volume numbers aren't printed. He actually said this because the volume numbers aren't printed, so you don't have adequate data to prove they're actually doing anything wrong. Well, duh, that means you can't actually prove they're doing it right either. If you can't prove they're doing it wrong, you can't prove they're doing it right because it's missing the data. Thank you for proving my point. If you guys have been following me on Twitter, you see these ridiculous these people that come in as gold and silver market experts that come in and make these ridiculous arguments. And that's why you can't trust everybody in the gold and silver space. You really have to look at the motivations of the person giving you the information. I'm going to give you these nice research reports. I'm going to point out where the CME Group says that you can't rely on their numbers. Straight from the horse's mouth. I'm going to give you the nice research by Ronan Manley proving that they're basically full of crap. And I'm going to show you where the mainstream financial press and the LBMA, a sister market, is basically lying to your face. Maybe they're not intending to lie. Maybe they're believing whatever the CME is putting out. But it's tantamount to lying. Not that I'm accusing them of lying on purpose, but it's basically a lie. If it's bad information, it's a lie. Of course, this all goes back to the CME Group and the ineffective CFTC. So there you go, A to Z, the nutshell, how it works. And remember how the bullion banks get the gold and silver off the markets. They short it, hammering down the price, and then they use your longs to take it off the market. Goes ineligible. The CME Group says, right here, we have no damn idea how much we can use. It may never come back. And now we're doing all these schemes to use unapproved depositories, go get all these other companies to do 100-ounce bars, even though we've never used them before and we have no idea about chain of custody. Let's go back to that chain of custody thing real quick. We're going to use these unapproved depositories where we can't prove the chain of integrity. I'm not making this stuff up. Anyway, I think this proves the point. I'm going to stop sharing here. I think I've proven what the scheme is. I think it's definitive. I think there's enough information there. I know that people are going to come out and make comments. At this point, I don't even care anymore. I've done enough research. I know. I'm an auditor. I know this is a complete and utter mess. Why I do this for you is to help protect you. This affects the gold and silver prices and other commodity prices we use in every day. We don't know if they're true prices. We don't know if the inventories are there. If you feel as though you want to invest in gold and silver, and that's your choice, you make that choice. I'm not telling you to do that, but if you feel that's in your best interest, you may want to do it now. I don't think they have the gold and silver there. And I think it's been mispriced for so long that by the time you get around to making that choice, the prices may be way higher. That could come as soon as December. If they're really running thin on gold, that everybody's trying to get the gold and silver off the market with same day or same month spot contracts, what I call a shadow contract, which is not, you can't see in the data until they actually overwhelm the paper system, which is astounding. Then we may not make it to December. Don't know. I don't know how much time we have. You can't tell by the numbers. You can't audit them. And I don't believe the self-regulation, because that paper showed us the self-regulation doesn't work. Congress proved that in their research in the 1970s. So I know you guys make up your own mind. I wanted to present the data to you. I think I've answered all the detractor questions. Hope you guys enjoyed the video and the content. Until next time, this is Robert Kienzle, goldsilverpros.com.